How the rich use banks to get richer, what you need to know. The origins and evolution of the banking system. The banking system, as we know it today, has its roots deeply embedded in ancient history. As early as the 7th century BC, the prosperous city of Babylon saw its first bankers lending money at interest. The concept of a banknote appeared during this time, symbolizing a value equivalent to gold. Over time, the word bank evolved from the Italian word banco, meaning table, referring to the benches where money changers conducted business. As economies developed, banks expanded their operations, moving beyond simple currency exchanges to providing a variety of financial services. In the 12th century, the first private bank, known as the Bank of St. George in Genoa, was established. It became instrumental in financing wars and managing state debts, setting the foundation for modern banking. Despite its growing importance, the banking system has always been viewed with skepticism, with many considering bankers as greedy figures. This sentiment persists today, as the public remains distrustful of banks' operations. Footnote: this section traces the history of banking from its origins in Babylon to the formation of the first private bank, illustrating the long-standing relationship between finance, government, and public perception. How banks make money. One of the most common misconceptions about banks is that they simply store your money. In reality, banks make money by lending out the deposits they receive, often at a higher interest rate than they pay to depositors. For example, while a bank may offer a deposit interest rate of 1 to 2%, the interest rate on loans and mortgages is considerably higher. This difference, called the interest spread, is the primary way banks profit. However, banks do not just rely on deposits, they also make money by offering loans and creating new credit. When a bank lends money, it creates new money in the economy, a process known as fractional reserve banking. This practice has far-reaching implications, as it allows banks to create money out of thin air, essentially expanding the money supply. The central banks, like the Federal Reserve, play a role in regulating how much money banks can create by adjusting reserve requirements. This mechanism helps control inflation and maintain stability in the economy, but it also allows for the concentration of wealth in the hands of financial institutions. Footnote: this section explains how banks generate profit through the interest rate spread, lending, and the creation of new money under the fractional reserve banking system, highlighting the complexity of the financial system. The illusion of deposits. When you deposit money in a bank, it might seem like your money is being securely stored for your future use. However, the reality is that the bank does not hold your money in the way you might expect. The funds you deposit become part of the bank's assets, which are used to lend money to others or to invest in other financial ventures. While you technically own the money you deposited, the bank has the right to use it, often without your direct knowledge. This process leads to a significant problem. Banks often hold only a fraction of the deposits they receive in reserves, meaning that they do not have the full amount of money available at any given time to return to depositors. This practice, while legal, creates a scenario where money exists in the system in multiple forms. This concept is known as money creation, and it leads to an increase in the overall money supply, sometimes resulting in inflation. Footnote: this section discusses how banks don't actually store deposits but instead use them for lending and investment, thereby creating money in the system through fractional reserve banking. Banks prioritize their own interests. Banks, as businesses, are fundamentally driven by profit. While they do provide services to consumers, their primary objective is to maximize their earnings and control over the money within the system. Banks view their customers' money as an asset, which is why they are motivated to lend it out to others at higher rates than they offer on deposits. Banks also engage in practices like selling customer data to other financial institutions or using it to create new financial products. Furthermore, banks often prioritize their own needs over those of individual customers. They focus on increasing their assets, such as loans and investments, and are less concerned with the individual welfare of their customers unless it aligns with their financial goals. This business model has led to an ongoing trend where banks act in their own best interest, not necessarily those of the people who trust them with their money. Footnote: this section emphasizes that banks are businesses focused on maximizing their profits by lending, investing, and leveraging customer deposits, often prioritizing their own interests over the needs of individual clients. Bankers' incentives and loan approvals. One of the driving forces behind loan approvals in banks is the incentive structure for bankers. Bankers often receive bonuses based on the number of loans they approve, which can lead to a more lenient approach to approving loans, especially towards the end of the year when bonuses are at stake. This system creates a scenario where bankers are motivated to approve as many loans as possible to meet their targets, potentially leading to riskier lending practices. While this may seem like a strategy to stimulate the economy, it can also result in the creation of bad loans, which banks may later need to write off. As a result, the financial system is constantly in a cycle of lending, repaying, and defaulting, which contributes to the complexity and risks of the banking system. Footnote: this section explains how bankers are incentivized to approve loans, particularly to meet bonus targets, which can sometimes result in less scrutiny and riskier lending decisions. The hidden costs of bank fees and charges. Banks generate significant revenue from fees that many consumers are not fully aware of. These fees include service charges for account maintenance, overdraft fees, ATM withdrawal fees, and credit card fees. These charges are often applied without much transparency and can add up over time, draining consumers' resources. Additionally, banks use hidden fees like shadow taxes, which are indirect charges passed on to consumers through inflated product prices when they use credit cards. These fees are rarely acknowledged but significantly affect the consumer's bottom line. Another way banks profit is by selling customer data to third-party organizations, which can lead to additional hidden costs for consumers. These practices contribute to the overall complexity and opacity of the banking system, which may prevent individuals from understanding how much they are truly paying for banking services. Footnote: this section addresses the various hidden fees that banks impose on consumers, including service charges, credit card fees, and the sale of customer data, all of which contribute to the bank's revenue at the expense of the consumer. Better terms for wealthy clients. It's no secret that banks prefer wealthy clients. These individuals are seen as lower risk because they have more assets to back up their loans. As a result, they are offered better terms, lower interest rates, and more favorable conditions than those with fewer assets. This practice ensures that banks can protect their investments and minimize the risk of loan defaults. Wealthier individuals are also more likely to make large deposits, further benefiting the bank's profitability. This preferential treatment creates an environment where the rich get richer, as they are granted access to better financial opportunities and terms. The wealth disparity is thus further exacerbated by the banking system, which tends to serve the needs of the wealthy more than the average person. Footnote: this section explores how banks provide better terms to wealthy clients, further perpetuating wealth inequality by offering more favorable financial opportunities to those with greater assets. Conclusion: taking control of your finances. Understanding how the banking system works is crucial for anyone looking to secure their financial future. Instead of relying on traditional banking systems, which often favor financial institutions over individual consumers, consider alternatives such as investing your money in businesses or other assets that offer higher returns. Additionally, avoid using credit cards whenever possible, as they come with hidden fees and charges that only benefit the bank. By taking control of your finances, being aware of banking practices, and seeking alternative ways to grow your wealth, you can break free from the traditional financial system and build a more prosperous future. Footnote: this section concludes by encouraging viewers to become more financially aware and to seek alternative methods for growing wealth outside the traditional banking system, emphasizing the importance of taking control of one's financial future.